Gold and silver held strong in the face of rising U.S. stock market turbulence this week. Gold looks to be closing up around $20 an ounce, ending around $1,220 per troy ounce on the week. Silver's U.S. dollar spot price dropped to start the week, but fought back throughout the close relatively flat. Silver spot is right around the $14.65 per ounce mark. This week, we also saw a somewhat steep U.S. stock market sell-off, with the S&P 500 losing over 1,000 points. The S&P is down some 6% from its late September all-time highs last month, but the S&P is also up over 40% in value since candidate Trump called the U.S. stock market a big, fat, ugly bubble just about 2 years ago in September 2016. This week, President Trump, when asked about the week's stock market sell-off, described the Federal Reserve's somewhat recent rising interest rate policy as crazy, perhaps clearing room for a scapegoat if and when the U.S. stock market goes into recession. This week, we have a guest who will be speaking with me about the major macroeconomic environment at the moment. His name is Brent Johnson of Santiago Capital. Specific topics we will be discussing include the U.S. dollar's medium and long-term values versus other major currencies, and what that means for gold in the near, medium, and longer term. China, Europe, the USA, which will become the next major financial crisis epicenter. The U.S. stock market versus the bond market. What happens with major capital flows, and where might they be headed? Precious metals. Mostly we discuss gold, but some silver is touched upon towards the end of our discussion. We'll be right back with our guest.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hello and welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week, it's our pleasure to speak with Brent Johnson of Santiago Capital. This interview is being recorded Tuesday, October 9th, 4 p.m. Eastern. Brent, thanks for coming on our show this week.
Absolutely. Thanks for having me. Always happy to talk about gold in the markets.
Great. Well, Brent, I've been watching you for years now. I think you've a bunch of times you've created really nice, insightful videos on YouTube that kind of cover your thesis about the markets and such. So I've enjoyed watching those over the years. And your feed you're very active on Twitter, and I enjoy your steady stream of consciousness coming out of there. It seems like
you like it a lot more than my wife does. Hopefully I haven't completely offended you at some point. It does tend to be stream of consciousness from time to time, but hopefully it's not a total waste of time.
No, it's been fun, and it's always fun to watch you and Luke argue at one another. So
yeah. No, it's funny. Truth be told, I like Luke a lot. I think he's a good guy. I think he's a smart guy, and we just happen to disagree on a few things, so it's never anything personal.
No problem. I'm sure at some point we'll get Luke on the show too to explain his thesis and his theories. But you brought a slide to me. You sent me a presentation slide, and I suppose we can just jump into that and kind of go into what essentially what we're talking about mostly is about the U.S. dollar, because right now it seems that gold and silver really are trade around the U.S. dollar and how strong it is versus other currencies. And so that's mainly what we're going to be talking about, I suppose, today is about the dollar and what's going to happen with the dollar in the next years.
Yeah. Well, so why don't give me just a couple minutes and I'll kind of set the stage a little bit, because I'm kind of an outlier in the gold world, I guess, because I think that gold is going to go much, much higher in the years ahead, but I think it's going to do that for reasons that are different than most people that are in the gold world. I kind of came to this initially to the gold world. I was just a regular, financial advisor for a number of years and had a small allocation to gold in clients' portfolio, but it really wasn't until kind of just prior to and in the middle of the financial crisis that, I started thinking it was becoming much more important. And at the time, I came to it not for the inflation purposes. I really came to it for the counterparty risk purposes. So I understood the inflation argument, And, subsequent to 2008, when they rolled out all these, stimulus programs, I totally understood the inflation argument, and I thought that would be continued. But that wasn't the original reason I got in. I wanted something that wasn't anybody else's liability for my clients. And so, I didn't necessarily come into this with the idea that the dollar was going to hyperinflate and therefore gold was going to pay off. And so, I continue to believe that the dollar over the next, call it 2 to 3 years, maybe much shorter than that, is going to go much, much higher. And I think it's going to wreck the monetary system because the monetary system is just not designed for a strong dollar. And I think when the strong dollar starts wrecking the monetary system, it's going to cause, a lot of chaos. And I think that will eventually lead to both the dollar and gold going higher together. And then I think eventually the dollar will, go away in some form or another. Or at least the dollar as we know today will no longer be there, or will have to be dramatically devalued, or something will have to happen. Maybe it's another Plaza Accord. And at that point, gold will be the last man standing. And I say that because, gold isn't necessarily going to win every fight, but you can't kill it, so it can't lose, right?
Yeah, it's the one that's going to last.
It's been around for 5,000 years. It's going to be around for another 5,000 years. And, governments will continue to hate it because they don't like having, the control over their currency taken away from them. But, when their greed and their gluttony and their malfeasance shows itself, gold will do like it always does and do very well. And so I think that will play out again in the future, and that's why I think it's very important to have in some place in your portfolio some gold.
Okay, great. And as far as the slide deck, I suppose we go through a couple of these charts to just give people out there an idea of what you're talking about in terms of the big macro picture.
Sure. So. I started off with just a slide of the monetary base, and the monetary base. This slide might even be a year dated, but the monetary base, as of a year or so ago, was around 4 trillion, give or take a little bit. And so, if you look at it over the last 100 years, it's basically gone up, 90% of the time. So out of the last 100 years, it's gone up over 90 times, 90 years out of 100. So. The monetary base is almost always expanding. In any system that is always expanding, and it will eventually go parabolic. And parabolic curves don't end well. They always crash. And so that's kind of the basis for a lot of people in the gold world. Their argument that the dollar will eventually hyperinflate is because the Fed is just going to keep printing and printing and printing, and that will eventually cause the dollar to lose its value, and gold will do well. So. I think it's important to remember, though, that, all countries are doing this. It's not just the U.S. And I think a big mistake that a lot of people make is they analyze the dollar in a vacuum.
Right.
And if you just look at the dollar in a vacuum, then absolutely, it's a horrible currency. It's a messed up system that is doomed to fail. It's just simple math. One of the things I always say is if you believe in math, buy gold, because this fiat currency system is doomed to fail. But the reality is we don't just live in America. We live in a global world, and all the other countries are doing the same thing that we're doing. In fact, all those other countries are still doing all the stimulus that we did for several years, and we no longer are. So, we've got this $4 trillion of monetary base, but that's the monetary base. There's really $16 trillion in the U.S. banking system. And so, 12 trillion has been created out of thin air in the form of loans. But that is $12 trillion worth of claims on $4 trillion $4 trillion that actually exists. And, when the music stops, all 12 trillion are going to be trying to get their hands on the 4 trillion that actually exists. It's the same dynamic in the dollar market that exists in the gold market. Everybody completely understands it in the gold market. You can't make gold, you can't print gold. Everybody's going to need it. There's a limited supply, so the price is going to go up, right? Mm-hmm. The same thing exists in the dollar world. And everybody say, yeah, Brent, but the dollar can be printed. They can print it to oblivion. And that's true, they can, but they're not. And that's, I think people just need to come back to reality a little bit, is that yes, I thought when they started QE back in 2009 that they would continue it. I didn't think it would ever end. I thought they would just push it to the pedal to the metal and just print it to oblivion. Mm-hmm. But you know what? They didn't. They stopped. And not only did they stop, but they've been raising rates for over 2 years now.
Right.
And everybody else is still doing it. So our currency, has all these claims on it, but they're not printing any more of it. Now, at some point, will they? Of course they will. When the rubber really hits the road, when things really go bad, they will have to. But right now, they don't have to, because by us raising our interest rates, we're pulling capital from around the world, and that capital from around the world is being injected into our domestic market. It's basically having the same effect as when the Fed injected artificial money into our market. It doesn't matter whether the money's being injected from Frankfurt or Tokyo or Russia or wherever it is. The fact is new money is being injected into our economy, and it's coming from overseas. It's having the same effect as when the Fed was injecting money into our economy, and that's allowing Powell and the Fed to keep raising rates. It's allowing our markets to hold up, and it's to the detriment of everybody else. As capital leaves Europe, as capital leaves Asia, as capital leaves South America, and some of these other emerging markets, it denies those places of liquidity. It gives us the liquidity, and it becomes this vicious circle where, because now things are bad elsewhere, people have a flight to safety to the dollar, and even more capital comes to the U.S. So, when it's really a supply-demand issue, and not only just when I talk about the U.S. banking system, 16 trillion of assets on 4 trillion of a monetary base, but there's like 60 or 70 trillion dollars of dollar debts out there worldwide. People always talk about the 20 trillion that the U.S. government owes. That's true, and that's a problem. But what's an even bigger problem is that there's institutions and entities outside the United States that also owe $20 trillion in dollars, and they can't print them. And their currencies are going down, ours is going up, and that 20 trillion is getting even more and more harder to pay. So when people talk about the 20 trillion debt that we have, it's a big problem. I acknowledge it. The 20 trillion that people outside the United States owe is an even bigger problem. And until everything blows up, it's a relative game. And on a relative basis, the dollar looks better than any of the other fiat currencies.
Yeah, and just, I was looking today. Right now, you have Italy's 10-year yield spiking again. That was just a few years back that it was above these levels, but obviously ECB has kind of pushed that down, but it looks like it's percolating again.
Yeah.
So there's questions going on in the euro. It's how stable is that currency? So when you look at the entire financial system, obviously the U.S. dollar is the hegemonic currency. It's 60% of reserves. The next largest would be the euro, and then the yen.
Right.
So those are the most important currencies. So,
and there's two other aspects of it that I think are important, and that is, a lot of the people who will disagree with my theory will say that, yes, Brent, that's true, but people are sick and tired of being bullied by the United States. They're sick and tired of having the dollar used as a weapon. They're sick and tired of being held at the whim of whatever the United States wants to do. And again, I'm not going to argue that point. That's 100% correct. People are sick of using the dollar. People are sick of the current system. People are sick of being bullied. Mm-hmm. The problem is they've taken out all these dollar loans. They owe dollars. Not only that, but most of world trade is conducted in dollars. And so they have to use it. Now, then they'll say, well, but Brent, that they're going to de-dollarize. They're going to, trade amongst themselves. Well, again, that could happen someday, but it's not ready to go today. That system that people talk about, it doesn't exist. Now, can they build it? Sure. But all the pipes through which capital flows around the world goes through U.S. institutions right now. And if Russia and China and Europe and everybody else decide that they're going to trade without the dollar, then Trump's going to say, fine, then you're not using our pipes anymore. You're not using our institutions anymore. You're not trading with us anymore. I don't know too many businesses that are willing to give away their one or two biggest customers and still stay in business. And so can they do it? Sure, they can do it, but it's going to be via an incredible amount of pain. And I would argue that the pain is already big enough that if they had a solution ready to go today, it would have already been implemented. It wouldn't still be a theory out there that they talk about doing. So even again, I'm not going to challenge the fact that people want another system, but they don't have one currently. And I think it will be a while before they do.
Right. They don't have one at least the size and scope that's required to meet the capital flows.
Right.
Right.
Exactly.
I totally get what you're saying. The trends are there, but it's not even close to being efficient.
Right. It kind of reminds me, when you hear about these this special purpose vehicle that China or I'm sorry, Europe and Iran and maybe China are going to use to buy oil from Iran. It kind of reminds me of these tunnels that Elon Musk is going to build under LA to really sure, will it work? Will it divert some traffic? Sure, of course it will. But I'm pretty sure that I-5 down in LA is still going to be a traffic jam come Friday evening. So
right.
Um,
So as far as right now, I'm just looking at the U.S. dollar index. It's like at 95 and change, what have you. Obviously, it strengthened in 2014 and has been kind of sideways, up and down a little bit in a range since then. What are you thinking in terms of the next year or two? How bad could this go? How strong could the dollar get versus the other currencies? Because that's what it's measured against, right? It's the U.S. dollar being measured against the other major currencies. How much higher could it go?
well, so I think it's going to go much, much higher. And I always try to be a little careful, not to sound hyperbolic. But I think one of the problems in the gold world is everybody sounds hyperbolic. And,
Right.
I think we need to have a little bit of reality brought back to it. That said, I think it's very possible that the dollar goes back to, 120, 130 area.
Wow.
And I think it's possible as some kind of a super spike, on some kind of a big blow up, something that even goes back to all time highs, a couple of years down the road. So I don't think it stays there very long when it does it, but I think it's very possible that it happens.
So you're talking Plaza Accord type ranges,
Yeah.
right?
Yeah.
And that's amazing. It's a huge spike. So I mean, in that type of world, if that were occurring, what would that do to the U.S. dollar price of gold? How would you see that playing out?
Well, so that's that's the $1 million question again. I'm not convinced that we've seen the bottom in gold.
Right.
It would be nice if we had. I would like it if. I manage overall client portfolios that have equities and fixed income and real estate and commodities, and gold is a part of it.
Sure.
And generally gold is the smallest piece of the portfolio. I wish it was bigger for most people, but it's generally the smallest part of the portfolio because it's the insurance policy for everything else.
Right.
So, if you're going to have a portfolio and one part's going to do bad, I guess you want the smallest part to do the worst, right?
Sure.
From an overall return perspective. So from that perspective, I don't mind that gold goes down because, it's an insurance policy. It's not everything. That said, I happen to think it's the most important. I think it's going to do the best in the years ahead, but I don't know that necessarily means it's going to be this year or next year.
Right.
I think it very well could be, but I think what will happen is and again, this is in the we can talk about the very, very short term in a few minutes, but I think as the dollar initially breaks out, and I don't think the dollar has started to break out over the last 2 or 3 months, but it hasn't even really made a move yet, in my opinion. I think when the dollar really breaks out initially, that's going to be tough for gold. But I also think that it won't take long until the damage from a strong dollar will start feeding into all these other global markets, and that gold will start to get a bid from a flight to quality standpoint. So I do think there will be a period of time where they rise together. It's just, in my mind, it's just a matter of how quickly the strong dollar starts causing damage all over around the world. And, the signs are showing that it doesn't have to go much higher before that happens.
Right. Yeah, that's for sure. Just looking around the world, what's gone on in the last few years, it's obvious that there's pain already. So are you part of this? I mean, when you look at the different asset classes, obviously you're a wealth manager, so you're looking at various asset classes from fixed income, bonds, et cetera, to the equity markets today, to commodities, to precious metals. I mean, obviously, if you look at what's overvalued, what's undervalued, commodities are at historic lows at this moment, versus equity markets and versus bonds. I mean, there's various camps out there who think the bond market may have an issue, and that'll feed capital flows to the equity market, which will give us new all-time highs in the S&P and Dow. Do you believe that that's possible, or what do you see?
I tend to agree with that more than not agree with it.
Yeah.
I think that's essentially what's going to happen. I don't necessarily think treasuries are going to crash.
Mm-hmm.
So again, we need to, when we talk about fixed income, I need to separate everything U.S. versus the rest of the world, right?
Sure.
I think rest of the world, I think from a very basic standpoint, I think interest rates are going higher. Now, will there be a few periods of time where rates rally and bonds rally? And it looks like they're going to go back into a bull market. Sure, nothing goes in a straight line, but I think in general, interest rates have bottomed and they're going higher. I think they're going higher in the U.S. because real rates are rising and we're getting inflationary pressures in the U.S. I think they're going higher outside the United States because of credit deterioration. Italy's yields are not going up because of inflationary pressures.
Right.
Italy's yields are going up because people are scared as hell to buy their bonds, right? And they want to get compensated more to do so.
Sure.
And I think that's kind of the general consensus around the world is that bond prices are going to go up, and the CDS in places like Turkey and Brazil and Italy, and those are going up because of credit concerns, not because of inflationary concerns. So I do think that as capital flows into the U.S. into the dollar, I think it's going to find its way into the stock market, and I think the stock market's going to go higher. And there's a part of me that can't believe I'm saying this, because I'm not saying that it should happen, and I'm not saying that equities are undervalued, and I'm not saying that this is a great entry point. I'm just saying I think it's going to happen, right?
Right. So one way I've heard someone explain that is, if you have capital and large capital, like so much capital that you can't move it into bullion per se. It's something where you have to move it.
Yeah.
Would you rather trust the board of IBM for instance versus the policymakers in Italy? I mean, who would you trust more, right?
And that's exactly it. That's exactly it.
Right.
And that's the other thing is a lot of people say, well, Brent, they'll go to gold, and of course they'll go to gold. But what people don't understand is that these big capital flows from around the world, the people that are running these, it's typically not individuals, right? Typically not one billionaire. Billionaire, he's got his gold hidden somewhere.
Right.
Any billionaire that tells you he doesn't have gold is probably lying to you. He probably does have some.
Sure.
Right?
Sure.
But these big institutions that are allocating capital, they have investment policy statements and they have guidelines, and I guarantee you their guidelines do not allow them to put 100% of their $400 million into gold, right?
Sure.
And so maybe they can put 5%. Some crazy board may have allowed them to put 10%. I'm being facetious because I think it should be higher than that, but I know it's not.
Right.
So, even if they put 5 or 10% into gold, and that will be very good for gold, there's still a lot of other capital that's got to find a home.
Right.
And I think that's why I think U.S. Treasury yields will rise, but I don't think Treasuries will crash. I don't think the U.S. is going to have trouble funding the government, because if people were buying Treasuries at 1.4%, I think they're going to be happy to buy them at 3%. Nobody gets fired by buying a U.S. Treasury bond, right?
Right.
Most of these people that are asset allocators, they're not necessarily trying to hit a home run. Their first concern is just don't get fired.
Right.
Right.
Yep.
And you don't get fired by buying Treasury bonds. Now, maybe you should, but you just don't.
Right.
And I think because of that, the U.S. will be able to continue funding its deficits. I think the dollar, will gain strength on the back of our higher rates. I think that'll pull capital to the U.S. I think a lot of it will go into the U.S. equity market. And then you get back into this vicious, circle outside the U.S. and this benign circle inside the U.S. that I was talking about earlier. And this will end really, really badly. I just don't think it's over yet.
Right. Yeah. So we're talking a few more years of this cycle where gold is, people are kind of not fully sure about where gold's headed.
Right.
So
again, I think I buy gold for insurance purposes. Now, there's people out there that speculate in gold, right? Or they buy gold miners because they don't want to just make what gold's going to make. They want leverage on the top of gold, and that's fine. Listen, there's nothing wrong with it. I don't think now is the time to be speculating in gold. I think it's important to own gold for insurance purposes. I think you'd be crazy to go through the next couple of years without having gold in your portfolio. But I also don't think that you necessarily need to bet the ranch on a few gold miners right now.
Sure.
Now maybe we've had this big pullback in gold, and one of the charts I sent you showed the commercial short position versus the gold price, and typically the commercials do have a big short position, but the commercials are actually long right now for the first time in like 10 or 15 years, and the speculative short position is the biggest it's been in 10 or 15 years. So we're setting up for a really nice rally in gold. But there's nothing that says it has to happen right here, because the counter argument is that if you look at the price of gold right now, it is sitting right on its 10-year support line. If you take a line all the way back to the lows of 2008 and extend it out, we are sitting right at that support channel,
Right.
on a weekly level, on a monthly level, and a quarterly level. And so, if we happen to break that support,
Right.
there's not a lot of support below it. And, crazy things can happen if we get a dollar spike and we get, a couple good jobs numbers over the next 2 or 3 months. And, for whatever reason, gold breaks the support line. It could fall more. I'm not going to sit here and say it can't happen.
Right. No.
But the flip side is we could be at 1,300 in 3 weeks too.
Yeah.
I mean, it's just, everything's kind of on a razor's edge here.
So when you look out further, obviously we have the unfunded liabilities and pensions in the Western world that you mentioned. I mean, at what point, and then you have China out there with the ridiculous balance sheet that they have as far as the yuan and how hard they've blown that out.
Yeah.
Obviously most of those yuan are owned internally, so I guess they can default on their own citizens, and they have their, they have their spy system set up, so you can kind of stop revolts pretty quickly there, and they have a president who's now president for life. So
right.
I'm not sure necessarily if China is going to be the savior here. The question, I guess, is which is going to hit the wall first? Is it going to be China, or is it going to be this unfunded liability and pension
it's going to be
crisis?
It's going to be
China.
Right.
Yeah.
We listen again. Analyzing us in a vacuum, we look horrible. Analyzing us versus China, we look like a king.
Right.
I mean, people are really overestimating China. They have been what they've accomplished over the last 30 years has been absolutely incredible.
Right.
But you got to remember, they accomplished it on the back of the greatest expanding debt. On their balance sheet in history.
Right.
I mean, they make our borrowings look like we're pikers. I mean, they've got $35 trillion in their banking system on 2 or 3 trillion of capital.
Right.
It's crazy. The amount of leverage in the Chinese banking system is historic. And they can't have an open
trading account,
account because, they can't have a free floating currency because the capital will flee,
right?
And it will cause a big unraveling. So that's what they're dealing with. So in my mind, there's no question that China hits the wall before the U.S. does.
Okay, and obviously, and then you look at Europe right now, it looks kind of like it's coming undone a little bit here with Italy. So you have a combination of that, and then Japan, I don't even know what's going on there. I'm guessing they've bought up their entire stock market, the central bank has.
Well, it's a very good point. So China has their problems, but, let's look at Japan and Europe, because again, you kind of look at this two ways. We're all riding on the Titanic, right? The entire monetary system is the Titanic, and the entire monetary system is going to go down. So definitely you got to own gold, right? You have to own gold because the whole ship could go down and will go down. But in the meantime, we're playing poker in one of the rooms, right? And it's us and China and Italy and Japan, and we have the best hand. We just do. I'm sorry.
Right.
China has all its problems. Japan, their government bonds don't even trade. Italy. Nobody's going to buy Italian bonds except for Mario, and when Mario's done buying, who's going to buy? It's again, I have no problem with people criticizing the U.S. The U.S. deserves all the criticism it gets, but let's keep it in perspective compared to everybody else. If there was anybody else out there, acting remotely responsible or wasn't in a similar situation, I would change my tune, but there's just not.
One other point, and this goes back to something you created, I don't know, last year or so. And I'll put it in the slide deck as we're going through this video. You made a really nice graphic that had all the M0 and M1 and M2 currencies of various large countries and their official gold holdings. And the most surprising thing about it was Russia, who is pretty prudent right now. If you look at their balance sheet, It looks like they have the most gold-backed currency in the world. I think the figures was like $2,100 gold would make their M0 fully backed by their official gold reserves.
Yep. That's right. Their float of their currency isn't nearly big enough to take on. And I don't, call me crazy, but I just don't see the rest of the world switching from dollars to rubles.
No, I know.
Trade.
I know that.
Maybe they should, but again, it's just, what people should do and what people will do are kind of two different things.
I'd be remiss not to ask it. I don't think I've ever heard you talk about silver or any other precious metals. Are
Yeah.
there any others that you have interest in? Is it just mainly gold
Yeah,
that
I
you're?
mean, I think gold and silver are going to do phenomenally well in the years ahead. I don't know what the hell's going to happen over the next year or so, but I think silver will outperform gold over the next 5 to 10 years.
Right.
But it's going to be a hell of a ride. I mean, I think gold will be volatile. I think silver will be volatile on steroids.
Right.
It's just unfortunately it's not for the faint of heart. And I'm going to use this example, and it's admittedly a horrible example. I just can't think of a better one. And gold is kind of like chemotherapy. It if you have we've got this cancerous system, and you can you can either just let it go or you can try to fight it. And the way you fight it is you buy some gold and buy some silver. But if anybody who's ever gone through chemo knows it's a battle, and it doesn't feel good, and it hurts, and you want to throw up half the time, right?
Right.
That's kind of what being a gold holder's like, but it might save your life too, right?
Right.
And so, apologies to anybody who's ever had a cancer victim in their life, because I know it's a horrible example, but that's really kind of the best analogy I can use.
Well, great, Brent. I appreciate you taking us through your slides and talking about macro thesis about the next coming years. Is there anything else you want to get across to the listeners before we close this out?
No, I think I would just say this. I think one of the big problems I see with a lot of analysts or people, market commentators, is they see a possibility and they immediately turn it into a probability, and not only into a probability, but a high probability. And so there's nothing wrong with having an imagination, and there's nothing wrong with looking at all these different potentialities. But just because something is possible doesn't mean it's probable, and you shouldn't bet the farm on it. Again, I'm very sympathetic to the weak dollar idea, and I would love to be convinced of it if somebody could convince me of it. But I just can't see it. I mean, I think at some point you just got to realize that the rest of the world doesn't think like people in the gold world do, and someday they will. And when they do, then the gold price will react. But right now, I think the best thing to do is put yourself in their shoes and not just look at it from their point of view, but try to think of things like they would think of it rather than how you think of it. And, and maybe that'll help kind of figure out, how this path is going to roll out.
Great. And Brent, how could people follow you if they're interested in hearing from you further in the future?
Yeah, sure. So anybody can email me at any time. It's just brent@santiagocapital.com, at Santiago AU Fund on Twitter. I do a lot of these podcasts. Again, I appreciate you having me on. I'm always happy to come back and do it again. But I generally try to answer people. I don't always do it. I try, but if you send me something and I don't respond, feel free to send another one or send another request. I'll get to it as soon as I can. And I appreciate people, wanting to hear my thoughts. So I'm happy to have a dialogue should anybody want to do it.
Thank you, Brent, for coming on the show today, and thanks listeners out there for tuning in.